Hi everyone, welcome to Decimal Point Analytics Unplugged. I'm Mohini Jadhav, your host. Today, we are going to dive into decoding capital market expectations. How quants use statistics to navigate market trends. Joining me is Ashutosh Mali, AVP SSU, Valuations and Advisory at DPM. Ashutosh brings over 7 years of extensive work experience and leads the statistical unit at DPM. Ashutosh, warm welcome to you.
Yeah. Thank you, Mohini, for the warm welcome. Pleasure to be here. Really excited to be part of this podcast and looking forward to our discussion today.
That's great to hear, Ashutosh. Let's jump right into it. Could you start by telling us about your work experience, about your past experiences and your current role in DPM?
Yeah, sure. So, hi all. I'm Ashutosh, and I'm currently working as an AVP and leading the Statistical Significant Unit, which is formerly known as the Quants team under Valuation and Advisory Department. So, I have in total 7 years of experience, which spans across both DPA and TCS. Coming to my academics, I completed my MBA from IIM Trichy. I am a CFA charter holder. I'm also currently pursuing my FRM and recently passed the Part 1 exam.
That's interesting. Many people hear about statistics being used in finance, but what makes it the engine driving quantitative finance? How do statistics transform data into actionable investment decisions?
So statistics and finance are deeply interconnected, with statistics forming the foundation for virtually every quantitative models out there. So whether you are estimating risk, analyzing return, or optimizing portfolio, so you often use tools like regression, correlation matrices, and probability distribution to quantify relationships or to forecast any future outcomes.
That makes a lot of sense. Now, predicting future often sounds like magic, but how do quants use statistics to make realistic capital market decisions? What's the trick?
Capital market expectations are built on statistical prediction of asset class return, risk, and correlation. So quants use time series analysis and econometrics model to forecast this expectation. So we gather data on everything, starting from inflation expectation to interest rate to corporate earnings growth. Then we apply a statistical model to project forward-looking returns. So one key concept is factor-based investing. So where we analyze drivers like value, growth, volatility, and momentum across different sectors and regions. So if you're a fan of MCU and the Avenger, you might recall how Doctor Strange explored multiple simulations against Thanos. Similarly, Monte Carlo simulation enable quants to test potential outcomes by creating a wide range of simulations considering multiple scenarios.
That's fascinating, especially with the complexities in the market conditions. How do quants adjust their capital market expectations when macroeconomic conditions shift suddenly?
So quants use dynamic models such as VECM, also known as vector error correction model, to recalibrate their forecast when there is a macroeconomic shift. For example, if there is an interest rate cut, the model can integrate new data into the existing trend that can update the capital market expectation accordingly. So when the yield curve starts flattening, this could signal an economic slowdown. Then quant can reassess bond returns and may advise reallocating part of the portfolio towards equities or growth sectors like technology. So the models integrate short-term fluctuation with long-term equilibrium expectations, ensuring the prediction remain responsive to evolving market conditions.
That's quite interesting. The yield curve seems to be a powerful tool. What secrets does it hold, and how can quants use it to predict future market shifts?
So the yield curve provides key insights into future market expectations. So a steep curve might suggest that there is future economic growth, while a flattening or a inverted yield curve indicates concerns about a slowdown. So by analyzing the statistical relationship within the yield curve, we can forecast interest rate changes, inflation expectations, and bond performance.
That's quite insightful, Ashutosh. Now, when it comes to the portfolio management, how do managers strike the balance between high level asset decisions and selecting best individual stocks or bonds?
So essentially, there are two decisions at play here. One is the macro decision, and the second one is micro decision. So the macro decision is at the asset class level, where the portfolio managers decide how much of the capital to allocate across different asset classes, be it equities, real estate, alternatives, etc. The classic approach is mean variance optimization, which balances the return and risk across a portfolio. And coming to the micro decision, the portfolio managers apply a factor-based model across broader asset classes. So factors like value, growth, volatility, and quality are statistically tested to determine which stocks or bonds are likely to overperform.
That's a great breakdown between macro and micro level decisions. Speaking of decisions, when do quants decide to hit the balance pattern on portfolios? And what typically triggers those actions?
Sure. So some of the rebalancing occurs periodically, such as quarterly or semi-annually. So another approach to rebalancing is driven by statistical metrics like, let's say, portfolio drift. So, for example, if equities outperform and the equity weight exceeds the target by, let's say, 5%, so quants might automatically trigger a rebalance. Some models also consider transaction cost, which ensure that the model is cost effective.
That's quite strategic. Now, evaluating performance is a key part of managing portfolios. How do you go about assessing whether a portfolio is truly performing well?
So we assess both the absolute return as well as the risk-adjusted return. So active returns against a benchmark is critical. So performance attribution plays a key role where we dissect the sources of portfolio return. So use statistical models like SARP, tracking error, and Jensen's alpha to evaluate whether the returns were driven by statistical asset allocation or simply by a market exposure.
That's important for understanding from where it comes. So, how can portfolio managers use the attribution analysis to identify what's driving returns? And how can those use the insights to their advantage?
So attribution analysis helps the managers dissect those sources of portfolio return. So it distinguishes between those driven by asset allocation and those from security selection. So statistical models like Brinson can break down returns to isolate how much of the return came from managers' decision against the broader market movements.
That's a great perspective, Ashutosh. As we wrap up, now what's the difference between striking a long term strategy and making statistical shifts in asset allocation when market conditions change?
So the strategic asset allocation sets a long-term baseline for optimizing returns over time, whereas the tactical asset allocation involves short-term adjustment based on market signal. It could be interest rate changes to capitalize on the emerging market opportunities.
That's a great perspective, Ashutosh. As we wrap up, how do you see the interplay between data and human judgment in finance evolving?
So that's a great closing question, Mohini. So while statistics provide a lot of powerful insights, so they don't replace human judgment at all. So models are only as good as the data and assumptions they are based on. This is where the art of finance meets the science. So we ask quants analysts combine rigorous statistical analysis with market insights and economic intuition. So, for instance, geopolitical factors like Russia-Ukraine conflict may introduce new variables that models might not account for, making human interpretation essential.
I see. That's great. And actually, that concludes today's episode of Decimal Point Analytics Unplugged. Thank you, Ashutosh, for sharing your insights. Thank you,
Thank you. Thank you, everyone.
listeners. We hope you found this discussion informative. Be sure to tune in next time for more such conversations on industry trends.